Kitco Mining's special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.
Is this the year for gold? This is Paul Harris for Kitco Mining at the Vancouver Resource Investor Conference in Canada. Joining me this morning to hopefully answer this question is Ronald-Peter Stoeferle, Managing Partner and Fund Manager at Incrementum. Ronald, welcome back to Kitco Mining.
Good morning, Paul. How are you?
I'm very well, thank you. Now, when we spoke last November, I asked you what are the things you're looking forward to and hoping for in 2024. Top of your list was that Austria would win the European Championships. After we spoke, Austria qualified, so congratulations there. But seriously, one of the things we talked about was the importance of gold establishing a floor at the US $2,000 per ounce mark. 2024 started with gold comfortably above that level. To what extent is that good, and what will it mean for the year ahead?
Well, I think that level, of course, from a psychological point of view, 2000 is a level that everybody really cares about. From my point of view, it doesn't make a big difference if we're trading at 2020 or 1980. Actually, I think what's really important is that the bull market is clearly intact. We're seeing, and I think that's really the interesting thing. We've seen new all-time highs last year in US dollar terms. Paul, you know, I always emphasize the topic, well, gold shouldn't just be looked at in dollar terms, but also in euro terms, in Canadian dollar terms, in Japanese yen terms, and so on. And actually, gold has made new all-time highs in all those currencies over the last couple of years, but not in dollar terms. That changed last year. And to be honest, I kind of hoped that we would see a little bit more momentum, like impulsive breakouts to 2,200, 2,300. It hasn't happened. But that doesn't necessarily mean that I'm negative on gold now. I just think that it's going to take a little bit longer from my point of view. If you have a look at Commitment of Traders report, for example, commercials are heavily net short, so that could put some pressure on the price of gold. Then we're seeing that the Federal Reserve doesn't like the fact that the market is discounting 7 rate cuts now. So I think they will try to appear a little bit more hawkish. Then we're seeing some sort of a bounce in treasury yields. So therefore, for the very short term, I would say, well, sideways, perhaps slightly lower, but over the long term, I think it is a bull market that is not really being seen by the institutional players. So from my point of view, actually central banks from the emerging markets tremendously helped the price of gold over the last 2 years because, let's face it, investors' demand was very, very sluggish. ETF demand, there were outflows like 250 tons last year. So at some point, I think, investors being the marginal players and the marginal buyers, I think this will really be a trigger. And the fact that gold is trading at or close to new all-time highs, while nobody really cares about gold in the investment world, I think that's a very, very positive divergence.
I think it's interesting, your point that the US dollar's finally caught up with the world's other major currencies in establishing an all-time high price in gold. But then going forward in terms of really breaking out, gold's ascent has been steady.
Yeah.
Slow but steady. And is that how gold is going to break out above $2,000? It's not going to be an overnight, as you say, up to 2,200 or 2,500. It's just going to continue slowly building towards those levels throughout the year, as the year progresses.
I think it's kind of taking a breather. Let's not forget, I mean, the last couple of years have been really good for us. So since the year 2000, gold, the compound annual growth rate of gold is 8.5% per year in US dollar terms. I would say that's a pretty decent performance. And I think that, you know, going forward, what will really be the crucial topic is obviously what the Federal Reserve going to do. And this is a topic that I will also be highlighting at my speech. I think if you would have told me 2 years ago that US interest rates would be above 5% and the price of gold is trading at all-time highs, while inflation is coming down. So we've seen real rates actually exploding. I would have said, well, gold should be trading at 1600. So that means, from my point of view, the gold playbook has changed. I think we should, perhaps the Western world has kind of lost control of the gold price, yeah? And therefore it was really interesting for me to deliver a keynote in Dubai and hold a seminar for the Dubai Gold Exchange, because you can tell that actually the infrastructure and the demand and really the long-term view on gold in this part of the world is a completely different one. So I think that's going to be a long-term trend, and the second, and probably price-wise the most important trigger, will be when the Federal Reserve starts cutting interest rates. So gold, I would say the best is yet to come. I've got one slide that basically shows how the price of gold developed after the Fed basically hitting the pause button. And usually when they hit the pause button, that means with some time lag of a couple of months, they start cutting rates again. And if you have a look at this chart, you can see that, well, actually, this phase of the rate cycle has been by far the best one. And that makes me very, very confident for the price of gold.
The US Federal Reserve seems to be, well, it doesn't seem to be too dogmatic. It seems to be very sort of touchy-feely with what's happening in the market, feeding into what it does or does not do. And as you just mentioned, in terms of the rate cut, it seems to be waiting to sort of time those so have the impact, the desired impact. Do you see that continuing to be their sort of philosophy and their way of modifying rates going forward?
I would say that, when we last talked in November, I said we're getting closer to the pivot. And that was pretty accurate, because in December, the December meeting, if you really listen to Jay Powell, it was crystal clear, okay, that's it, yeah. We won't see any further rate hikes. I mean, the market, like a little dog, moved ahead too quickly from my point of view. And I think the Federal Reserve doesn't like the fact that 7 rate cuts are now being discounted. But I think it's crystal clear that we've seen the top in this cycle. Now the big question is what has actually changed for the Federal Reserve for this pretty quick pivot, actually, because if you listen to them in September, there was a completely different communication. It could be, first of all, that they're seeing, well, actually inflation numbers will come down more dramatically, so the whole inflation scare is over. Second thing could be, well, actually they see the risks of a recession, and that's probably that's what I see developing. And the third thing is probably that they see that Donald Trump has got much better numbers than Joe Biden, and that might be, I don't want to say it's a conspiracy story, but if you have a look at the comments of Donald Trump regarding Jay Powell, he said it was the worst decision that he ever made. He said Jay Powell is a golfer that cannot put. I think that there might also be some personal thing going on, and I think that perhaps they want to avoid Donald Trump being elected. So one of those three things, or a combination of those three things, must have happened. And now I think it is crystal clear that rates will be lowered. There's no question about that. It is crystal clear that supports the price of gold in general. And from my point of view, I'm still not in the no landing or in the soft landing camp. I'm clearly in the recession camp. It took much longer because we're seeing an enormous amount of fiscal stimulus. Last year we had like a budget deficit of roughly 8% in a year of full employment. So we've never seen, outside years of wars or recession, such an enormous government deficit. And of course it works, yeah. But I think most of these effects, of these fiscal stimulus effects, are fading out this year. And therefore, I would see a recession on the horizon, probably even in the first half of this year.
Interesting comment there. The US Federal Reserve, a lot of people think should be independent politically, but it does seem that there is, there's always an eye of what's going on in the broader environment, and obviously the US election cycle and what is happening there is a key driver for things in general. To what extent or not do you think the US Federal Reserve is factoring in those considerations or those developments into its decision making?
Well, they are apolitical, obviously, yeah. But then on the other hand, I mean, I would say that the Federal Reserve, of course, is a part of the establishment. And Donald Trump, obviously, you can say a lot of things about him, but he's not establishment, he's anti-establishment. And I think that creates some pushback. And of course, I mean, they shouldn't care about those surveys and what's going on in the political scheme. But still, I think it's perhaps also subconsciously, it is something that's probably on their minds. And therefore, I would say that if you study the history of presidential cycles and election years, actually they tended to be more on the dovish side in election years. Yeah. So I don't see why it should be different this year.
Okay, then let's broaden the conversation to a more sort of global aspect. Last year, a key theme was de-dollarization of trade and the de-dollarization of holding reserves. What's your overview or your conclusion of what happened last year? And do you expect to continue to see that happening this year?
Well, we always said that de-dollarization is a very long process, yeah, and we're in the middle of this process, yeah. It's probably not the first inning, but also not the last inning. And my take has always been that, you know, this central bank buying that we're seeing now, you know, record highs in 2022, more than 1,100 tons. We don't have the final numbers for 2023. But it's probably also been above 1,000 years. And it's mostly coming from Eastern central banks. Now the big question is, why are they buying gold that aggressively? And probably it's because of the sanctions against Russia, where basically the Western world said, okay, those reserves that you had are basically worthless pieces of paper. And that clearly changed something, yeah, and therefore I think this is really a long-term trend that we're seeing. It's not only China, it is India, it was Saudi Arabia buying, and it's Turkey, obviously. Within Europe, it's Poland, it's Czech Republic, it's Hungary, but also Singapore, for example. So it is really, it seems to be, I will call it in my presentation, a heel turn, when actually gold has always been something that is just lying around in the basement of the central banks. Now it is really becoming something that is much more valued as a dollar hedge, as a means to diversify, as an asset, as a reserve asset without any counterparty risk, a very, very liquid reserve asset. So I think this is really, really important when it comes to the price of gold. So central bank buying will be one of the main drivers. And investors' demand at some point will kick in, but we haven't seen it so far. But when it comes to de-dollarization, I think it is, I just don't see that the new system that we're moving into. If you have a look at the SWIFT numbers, and I'm not talking about Taylor Swift, I'm talking about
Trying to get Taylor Swift into these interviews somehow.
Yeah. No, but the international banking transactions, you can see that actually the share of the dollar is rising while the share of the euro is falling. It has actually been falling off a cliff. So before we see de-dollarization, we probably see some sort of de-euroization. And the big question is, which system is it gonna be afterwards? Yeah, because the dollar is the world reserve currency is a network good. It's like, you know, we're not speaking German, we're not speaking Spanish, we're speaking English here. And if we switch to a new world language, first of all, it's costly. It takes lots of time. And I don't know, at some point we could have this conversation in German. I know that you're speaking German quite well. We could have it in Spanish, yeah? Perhaps in Mandarin at some point, but it's going to be costly. And the big question is, what is the major advantage, yeah, for switching the world reserve language or the world reserve currency? So it's going to take time. it is a process. I think that gold plays a major role in that process, but I don't think that we're seeing really the end of the dollar-centered world. However, when I was in Dubai and talking to gold traders from the United Arab Emirates, Saudi Arabia, China, India, for them talking about the end of the dollar is just something normal, yeah. And the real is pegged to the US dollar, but also the dirham in the United Arab Emirates. Yeah, so they are basically dealing with the central bank policy of the Federal Reserve, and they say, well, actually, why do we do that? Yeah, we could team up with all the other BRICS currencies, and we've seen many signs that there's something happening in this BRICS club, which became bigger this year with 5 new members. But then we're also seeing that Argentina, for example, who were supposed to join the BRICS, said no, we're not joining. We're rather in the dollarization camp. Yeah, so we're getting closer and closer with the Americans and with the US dollar. So it is a very complex topic. I think it is a topic worth following, but I think for investment decisions, it's not really relevant.
Another aspect that may or may not impact the gold price is the conflict. There's increasing tensions in the Middle East. There's indications that some conflicts are perhaps in that region are perhaps getting larger. If they do, what impacts do you think that will have on the gold price?
I think that October 7th, 2023 might be pretty similar to June 28th, 1914, when Austria declared war so the Austro-Hungarian Empire declared war on Serbia, and that actually kicked off the First World War. And obviously nobody said, okay, we want to start a world war. It just happened because of all the tensions that were building up for years, for decades. There is clearly an analogy with so many conflicts boiling in that region for many years, even centuries. I just can hope that I'm not a geopolitical analyst. Yeah, I've got my private opinion. I just can hope that we'll find a way out. At the moment, it doesn't seem like we're seeing the big escalation. But of course, it's not only the Israel situation, it's also the war in the Ukraine. There's many smaller conflicts coming up. So it is something very frightening. Now, does it really have a short-term impact for the price of gold? We crunched the numbers and analyzed, how wars or terror attacks affect the price of gold. We're seeing short-term effects, but over the long term, I would say that real interest rates, inflation especially, are much more important for the price of gold. But of course, wars mean more debt, they mean lower rates, and they mean higher inflation. So wars are clearly inflationary. But I would say, as a gold investor, I think, war shouldn't be your primary reason to buy gold.
Okay, let's change tack. Let's talk about the commodities, the equities now. Record prices for gold. Investors still don't seem to care about the gold equities, whether it's the majors, the producers, or the juniors. Why is there still that disconnect?
I sat down with Adrian Day yesterday and said, said, what is it gonna need to really for generalists to come into the mining space again? And I can tell you that I think many of the mining companies did a really good job in getting the cost inflation under control. So therefore, I would say that all-in sustaining cash costs this year, they will rise, but not that dramatically. I just see pristine balance sheets for many companies. I'm seeing really solid margins, but nobody cares about those companies. I think that one of the reasons is that last year especially the tech space did tremendously well again. Just one stat from Thorsten Slock at Apollo. He said that the Mag 7 stocks, so those super important technology stocks, they now have a higher market capitalization than the equity markets of Japan, the UK, and Canada. Just those 7 stocks. And that's quite telling. I think they're to some degree priced perfection, while many mining stocks are priced for, bankruptcy, it seems. At some point it's gonna change. And I think one of the analogies that we could make is for example, in the uranium space. We are running one uranium fund. My partner Christian Scher is managing it. He did launch that fund 2 weeks before Fukushima happened. So that was unfortunately poor timing. But the case for uranium, for many years, a simple supply-demand case, was so crystal clear. But people couldn't care less about it. And then, last year it really took off, and now everybody's talking about uranium. Even the big investment houses, the big institutional players, the media is becoming more positive about the topic. So it can happen quickly, but it usually takes a little bit longer than we all think. Can it happen to the gold mining space? Yes, I think so. And the only thing that the mining companies can do is just continue to work hard, try to deliver shareholder value, not screw it up with stupid M&A, get the costs really under control, and then I think it's gonna be fine. But as we all know, I think Jim Grant said that the universal law of investing is that investors get the most bearish at the lows and the most bullish at the tops. So yeah.
Using that as an analogy, uranium, it seems that the gold space isn't going to attract the generous investors until it actually does attract the generous investors. Until it moves, it's not going to move. Okay, let's wrap up with what are some of the things you're looking forward to or that you expect to see this year?
I would say that as I've said at the beginning, in the next couple of weeks, I'm not super optimistic on the price of gold. Yeah, perhaps we'll just go sideways. As I've said, it will have to. I think it all depends on the first rate cut. This will really be like the point when gold, from my point of view, will really start picking up momentum. I think in the commodity space, we can really find some bargains. I tweeted out this morning a survey by Bank of America where investors are most underweight commodities versus bonds since the end of 2008. And we all know that then starting later on, commodities did pretty well. But if you have a look at the chart of copper, for example, it's kind of a boring sideways trend. Yeah, so it's not really showing a deep recession. It's not really showing enormous growth. It's just kind of boring. If you have a look at the gold-silver ratio, you want to see silver outperforming gold actually. Yeah, if there would be a strong trend. You don't see it. Silver is hanging around at like 22, 23. So no big trend yet. So therefore, I think in the commodity space, there's now really the time to do your homework, to start allocating. I think also in the energy space, you're finding lots of attractive opportunities. In the lithium space, perhaps, nickel is one of my favorite metals. It has been killed last year, but I think the long-term outlook is a pretty positive one. And then one thing that you would probably not expect is, I think that for Bitcoin, it should become a really good year. We've got two funds that combine Bitcoin with gold. And I think with the ETFs now being launched by those financial powerhouses like BlackRock, Invesco, Van Eck, Franklin Templeton. If you have a look at, for example, the BlackRock webpage, on the first page, you see an advertisement for the BlackRock Bitcoin ETF. Yeah. So I think with all their marketing power, there will be an enormous amount of capital flowing into Bitcoin. Then we're seeing the halving in April, so that might be a good idea. And And then, as I've said, for gold, I'm pretty relaxed. I think we might see 2,400 this year, but I would expect that rather a little bit later on this year.
It's going to take time. Well, Ronald, thank you very much for joining us today. Fascinating as always.
Thank you, Paul. Thank you very much. Appreciate it.
And this is Paul Harris for Kitco Mining at the Vancouver Resource Investor Conference. If you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.